It was our time to party big.
What the fuck is going on out here?
Ladies and gentlemen, it has been a ride to say the least for those silver and gold holders. What can I say to you, man? It has been quite an eventful week. And of course, on Friday, we saw that smack. Well, not on Friday. Yeah, it was on Friday. That big drop to the downside with silver, with gold, of course. And who done it? You know, you got the speculation behind JP Morgan opening shorts at 123, I believe it was. And then, of course, it just rolled over from there. But what's good, ladies and gentlemen? We got some news. Yes. Blackrock's coming out with some interesting discussions about inflation. Given the fact that they are actually short on treasuries, why would they be doing that? I mean, when a fund that holds around $12.5 trillion worth of assets speaks and positions itself in certain assets, the market tends to listen. But BlackRock's coming out with the idea that no one is paying attention. So we're going to try and break down that logic to understand BlackRock's perspective on why they think that we're going to be going into an inflationary boom, which is going to have a little bit of a problem on your assets. Now, don't even get me started. If Bitcoin was the true hedge against inflation, it would have been surpassing gold. Some of you might not like that, but if you don't like the truth, then this environment is not for you. Get out of trading, because Wall Street is one of those tricky things. And Epstein, in that interview, he's been pretty much backing everything that we've been talking about with regards to the marketplace. It really is that simple. It's just Wall Street actually makes it really complicated by putting some really fancy words like derivatives and credit swaps and all of that stuff, just to make you think, okay, I need to do more onto that and pay more attention to the definitions of that. And then you're missing the bigger picture of everything, which is why when gold took a big move to the upside, paper gold value, of course, is going to come back down because it's fake money. It's synthetic. You're using leverage. Anyway, we're not going to get into that story because a lot of people did get burnt on that. So what are we talking about? We're going to break down BlackRock. We're going to break down everything that we need to know about the market. We're going to break down everything you need to know about this week because it's non-farm payrolls. And we got this new dude in the Federal Reserve, Mr. Warsh, who Trump did say that if he doesn't cut rates, he's going to sue him. But Mr. Warsh and his good friend Druckenmiller, when they wrote that article on the idea of why the Federal Reserve has increased interest rates when they shouldn't have back in the day in December, not this recent December, when those two guys start to speak together, the market needs to bloody listen. There's a reason why they're managing billions and billions of dollars. Jerome Powell and his gang are not managing billions of dollars. What they're managing is how often it gets printed. It's a different type of classification and understanding of the marketplace. So we're going to break it all down, give you everything that you guys need just before the actual open. And then hopefully, if you've enjoyed it, make sure you like, subscribe if you are new. My name is Tino. Let's make sense of this madness that is unfolding, ladies and gentlemen. Here we go. So, stocks fall. It's plunging metals, fan global sell-off. Let's just break it down going into it. Bitcoin, we'll talk about that in a split second, but let's just go over to our dearly beloved gold. Silver. Do you know that the market cap that was wiped from this move was $3 trillion? That's crypto. So you can appreciate when everybody's waiting for the rotation of Bitcoin, gold, and all of that stuff, well, it's gone now. So have we got every reason to get into Bitcoin now? Because Jim Cramer said that the 77 zone is the zone that everybody's going to be stepping in and buying. But let's just scale it back a little bit. You want Bitcoin to be expensive when you buy it at 120K. You don't want it to be you don't want it to be expensive when you're effectively in a loss. Well, you do. You do want it to be expensive when it's at a loss, but because you're making money. But you want it to just keep going up and up and up and up. And Bitcoin is starting to show the true aspect of risk on, risk off, which means that if they're not buying Bitcoin and they're going over to dollar, then you've got a bit of a problem. I think Bitcoin's become Wall Street's, you know what I'm going to say, and it's not nice. Some of you might unsubscribe from my channel because I talk like this. Well, you know what? I am unorthodox in my approach in how I deliver information, but tell me I'm wrong whenever you want to. And I stand up to be, I stand to be corrected. I was wrong to tell everyone on Instagram, don't buy gold yet. A week later, it shits the bed. So you know what? I'm open to discussions with anyone, but this is not clout. This is to get you to understand the nature of the game. All right? Forget gold's price as in the physical price. It's the silver and gold's paper price that made this move to the downside happen. Because everyone was over leveraged. It was too good to be true. Imagine waking up every morning and you're just increasing in value on your portfolio and it's not costing you anything. The market always makes you pay the price. That's why I always say to you, pay yourselves. So let's just break it all down. The stock stage a global retreat with the S&P futures pointing to a fourth day of declines. Going into the stock market, you can see here that the NASDAQ is toying with a very interesting range at the top side of its all-time high. This is the NASDAQ Composite Index, which makes up all the tech companies within the NASDAQ itself. Now, we are seeing that volume is above average on the sell side, so we'd understand this to be a distribution day or a fourth distribution day on the NASDAQ. But more importantly, we do have a very interesting week in terms of data. We've got the ISM manufacturing data coming out at 3 p.m. UK time, 10 a.m. Eastern Standard, and they are expecting a little bit of an expansion up to 48.5. And then, of course, the manufacturing prices are looking to increase, which is no good, which is going to marry up to the idea of what we're talking about very shortly, which is about Blackrock and PIMCO see inflation risks and the wider market is doubting it. So going into the calendar tomorrow, we also have the JOLTS job openings report. And then we're going into it, the ADP on Wednesday, ISM services PMI, which is showing expansionary yet again. It's still above 50. And then, of course, going into the week, we've got the ECB press conference and then the dearly beloved non-farm payrolls is going to be released. Now, what I'm going to do is show you a couple of charts that are going to either debunk the idea that inflation is actually going to be coming, and is it going to solidify the idea that BlackRock may be onto something with the fact that we could be going into an inflationary boom, which means that it's going to be a bit of a problem for the tech market because that means the yields are going to be shooting up given that they are short on the treasuries. So let's just break that logic down. It says here that money managers at BlackRock, Bridgewater Associates, you know Bridgewater Associates, Ray Dalio's old firm, Happy Days, and Pacific Investment Management Company are preparing for a potential fresh bout of inflation. It says here that the difference between yields on ordinary treasuries and inflation-protected notes has climbed sharply in January to the highest levels in months, and inflation swaps have also risen. Listen, what I'm going to show you right now, a chart surrounding the treasury yields and inflation. Take it as is, as an idea of maybe, yeah, BlackRock could be in line with the idea that inflation is going to occur. We've got tariffs, we've got geopolitical events, we've got oil bouncing up and down like someone on anyways. But more importantly, what we're going to be looking at right now is helping us justify whether BlackRock is right or wrong. If you think they're right, comment afterwards. If you think they're wrong, comment afterwards. But I'm going to present it all for you so you've got an understanding so that when you're sat with your friends and they're like, do you think inflation is going to be coming? I don't like the cost of eggs. I don't like the cost of chicken right now. You can present these sort of ideas to them. And then that way they'll be like, yo, man, what do you think about inflation or recession and all that? Whatever, but you get the idea. So let's start it off over here. What's this? This is the Fed rate versus inflation. Now, one of the key aspects to this is what happens when the cost or the PCE rises. Now, this orange line right here, to put it into perspective, you can see right there, this orange line is starting to climb up. That's a bit of a problem. Now, when we reset the zoom, if you can see, I'm going to zoom in a little bit for you so you can see it. All right, check this out. If you look at the differences when the actual PCE rises and where we are relative to the Fed funds rate, you can suggest that when the price of goods actually increases, that usually means that the Fed is going to want to increase interest rates to just try and suppress that, okay? Let's just look at 2010, and you can see this gray line right here. That gray line means recession. 2008, 2007, what was that? The subprime mortgage crisis. At that time, you can see that there was a massive increase. Where is it? There was a massive increase in the, where is it? Right here. You see that massive increase in the actual price of goods, okay? So we saw that increase right there. And that equally led to when the interest rates were at the 5.25, 5.3% interest rate. When the PCE rose up aggressively, the Federal Reserve understood that it's squeezing the marketplace, so we need to reduce the cost of business, and that's going to obviously make it easier for businesses to charge less. And that obviously led to a drastic drop down in the PCE and the drop in the federal funds rate, but it triggered a recession, which is exactly what this gray line is. Now, we had the last event where we saw the price, the core price itself rise, and then it led to the interest rates being high again around the 2.4 region. And then that led to a little mini recession in 2020 when we had the idea of COVID, okay? And then, of course, everything went back to normal. Interest rates were pretty much flat after COVID, and then they just increased it. And now we're at a spot when we're seeing an increase yet again on the PCE, and we are currently at a high level of interest rates, even though we've had some cuts. We were at 5%. Now we went to the 4%. Now we're back at the 3.75, which if we actually look at where we are with that, we ain't getting no interest rate cuts after March. Are we going to get any interest rate cuts? Well, I don't think so. Anyways, so this is where we are in terms of back in the story of Blackrock with their story of inflation. The PCE is starting to increase. And historically, when prices of goods and services increase, then that can lead to inflationary pressures. Let's bring this one over here. What's this chart, you say? This is the Treasury break-even inflation rate chart. Now, the green line is the S&P, okay? The blue, the yellow, and the red are effectively the 5-year break-even inflation rate, the 10-year, and the 20-year, okay? Now, in order to understand how this chart works, you've got to look at the 5-year, right? When the 5-year starts to make a bit of a move up, that means there's going to be a little bit of a problem. As it stands, it's not as bad, which is why the market's not really paying attention too much to it. But we are starting to see that the 5-year, which is this blue line, is starting to move up quite aggressively. Then you've got the 10-year and the 20-year currently trying to find balance, but there's not really that much movement. But the 5-year is going to move first, okay? So when this starts to go up, that can then lead to the idea of inflation coming into play. And when you look at it historically, when you see the 5-year trending upwards, it usually has an impact on the stock market, because when the yields on the dollar are rising, or if inflation is rising, the Fed is going to have to keep interest rates high just to contain that. That is naturally going to have an impact on the tech market, because they are subject to changes in yield on the 2-year mainly, and of course on the 5 and on the 10. Now, that's that logic right there. So we're backing up BlackRock's story of potentially going into an inflationary boom. Check this out. What's this? Ooh, what does this show you? This chart shows you central bank liquidity swaps. What does that have to do with anything? If you look at what's going on here, ladies and gentlemen, in front of you are the two main events that have happened in the marketplace. Subprime mortgage crisis 2007-2008. This is where the central bank claimed liquidity. They were seeking the liquidity. They got that liquidity right there. Whenever we see this cash injection from banks or requirement for liquidity, that is when you want to put the flipping house down and start buying everything up, okay? At that time, you can see the stock market had taken a nosedive. Subprime mortgage crisis 2007-2008. Let's jump over to this one. That's COVID 2020. Look what happened there. Slumped to the downside. But we haven't had any injection of liquidity as of yet. So what this chart tells us is the next crash, when we see a central bank claiming liquidity swaps, we can then assume the idea that money's coming into the marketplace to be put to work. And behind every single crash, there is a 100% success rate of the market recovering, because they're pumping money back into the marketplace. Okay? So going into it, we know that the PCE is going up, so that backs the story of inflation. We know over here that we are starting to see the 5-year increasing in terms of the break-even rate, all right? We know that's going to be the case for inflation. And then to back that story up, we haven't yet had the idea of any cash injections, which means that we haven't had a market crash for everything to reset. But it has to start with something, and that is inflation. Now, what's going to be the impact for that? Well, if we go over to the charts, we can see that gold has taken a nosedive. And given that BlackRock is, of course, going short on the treasuries. It says here, BlackRock Fund is building short positions in US treasuries and gilts in case lower interest rates fail to materialize. If lower interest rates fail to materialize, it means that rates are going to be kept higher for longer, with the possibility of interest rates being increased. Historically, the Fed has done that. They can just switch the narrative and go from an easing cycle to going back into a tightening one if they are struggling. And given that this new dude, Warsh, who is coming into this Fed chair position, and he's trying to review this $6.6 trillion quantitative easing hangover. In other words, listen, you've got to relax inflation before you can start pumping money back into the marketplace. And given that he is so hawkish, the prospects of interest rates being cut is starting to diminish as we get closer and closer to him stepping into the Fed chair and being the dude that hosts our FOMC press conferences. That's gonna. I'm gutted about that. I can't lie. I'm not happy about that. I'm gonna miss Powell. I'm not gonna lie. Anyways, gold. Just talking about gold right now. The CME effectively has increased the margins required to trade gold. And when we go and have a look at gold's price right now, they did gap down at the open and they've taken a little bit more of a tumble to the downside. And if Warsh, I can't even say his name, if he does actually come with a hawkish approach, that is going to be problematic for gold because it works inversely to interest rates. If interest rates are going to be high, then investors are going to be going to seek the yield in the dollar. Going over into the dollar itself, you can see that we have got a nice, interesting move to the upside. Why? Because investors are concerned about the way things are operating. They go back into gold when they feel like the projection of the future looks like we're going to get rate cuts. No, we're not, because Warsh is the guy that says he doesn't want rate cuts. He wants inflation down. So we go over to an asset that we can actually make money from, because gold will only make you money based on how much of it you hold and how much price actually moves from your position of purchase. That's it. You can't earn interest on gold, but you can earn on the dollar, which is why everyone is going into the dollar right now. On top of that, you've got geopolitical tensions that are making it a bit problematic for the world. You've also got this story right here with this donut, Keir Starmer, who's actually trying to get into a relationship with China, which is going to piss off Donald Trump quite aggressively. He says that it's dangerous for the UK to get involved with China. Now, Starmer wants to start talking about healthcare, whiskey, and all of that stuff with China. But why are you going to do that when you are under the radar for potential tariffs? Of course, you may be aware that Trump is now going to be telling everyone that anyone that does business with Cuba is going to experience tariffs. Now, he said primarily selling oil. But of course, if the UK is trying to get him to bed with China and it already supplies Cuba 110 million pounds worth of trades, goods and services in the last 4 quarters, Trump's going to turn around and say, all right, listen, you're up against us because you're doing business with Cuba. You want to do business with China. Well, you know what? We're just going to slap you some tariffs. And we go over to it. You can see if the dollar dominance is going up, then, of course, the pound is going to be taking a bit of a smack to the downside. And, of course, with the euro itself, that, too, is taking a bit of a move to the downside. And this morning on the Platinum Trade setups, I'm actually doing things a little bit differently in terms of the setups. What we're doing right now is it's called trading regimes as such. From my experience of going to the prop firm, I'm just pulling together the approach on how they actually prepare themselves for each trading day. And every day from now, any of the Platinum members that are part of that will be receiving a document where it factors in all of the news announcements that have hit the market, and it's split into narratives as whether or not it's a good thing for asset classes or not. And it gives them a breakdown or a go-to so that any news announcements that are released throughout the day, they can refer to this document and say, okay, then that is a problem for this asset class, already aware of that. And then they look at the news, and if the news says anything that supports the idea of it being a problem, then they can run shorts on that asset class. Or if it's a beneficial thing for that stock or asset, then they will be able to run longs on that asset class. And I do that for Euro, NASDAQ, gold, gold, Bitcoin, Ethereum, and Solana. So we've had a decent one today. I'll be frank with you. Euro itself, we were looking for Euro shorts on the back of this move to the downside based on the information from that. So we can go over to Euro and you can see it's just taking a rip to the downside right now, but it's understanding all of the information that's in that document has painted the picture to justify the logic of the short, because we are in right now event risk. We're not in trend risk. No. Event risk and trend risk are 2 different things. Event risk means one day you just sat at your charts and then you witness as price is going to the upside, you're optimistic about things. Then all of a sudden, swamp. Prices take a nosedive. What the hell is that? That's an event risk movement, okay? Whereas when you're in trend risk, it's like, okay, everything is moving up nicely and we've had a little bit of a corrective move. No news has really affected the marketplace, but trend is saying that everything is all good. So everything's going to continue with the narrative to the upside. Gold was technically in event risk because there were events that were coming out. Central banks buying up gold and silver. And then, of course, you got all this stuff about supply. JP Morgan holding 100 million ounces. Let's go back to the time when the Hunt brothers were doing the same thing. Back in 1979, when they were so over leveraged with their exposure on silver contracts. And then, of course, on a lovely Monday morning, everything took a shit to the downside, wiped those guys out. And of course, they still held onto the big vault supply. And of course, JP Morgan's in sort of that same boat where they actually made a killing and they got fined $930 million for defrauding the whole place. Anyway, we're not going to talk about that. Let's just go over and have a look at what's going on in the stock market. Oracle rises 5% after announcing $50 billion fundraising plan. Fundraising? What are you on about? Fundraising? Ain't you a big tech company with cash? When big tech starts to borrow money, that's a little bit of a problem because investors will turn around and be like, hold on a second, bro. Where are we at with the rates? Hold on. Let's have a look at where we are. 2-year yield right now, where you at? Up spot 0.6. Okay, then. 5-year, up spot 2.5. Okay. 10-year, up spot 2.4. 30-year is up 4 spot 8. Well, yeah, 0 spot 2.3. In other words, the yields are moving up. And with this article coming out on Blackrock, it's kind of making investors get a little bit concerned for worse because the treasuries themselves could be getting ready to make a bit of a move to the downside. But also on top of that, Trump is actively coming to the table saying that there could be a deal with Iran. There could be a deal with Cuba. And that is sort of easing geopolitical tensions, which is why gold will probably continue its narrative to the downside as well as silver. Why? Because, firstly, we're not going to get interest rate cuts anytime soon, so that inversely works against gold. We need to see rate cuts to see gold's price going up. Why? Because you earn interest on the dollar, and if they're keeping the interest rates high on the dollar, it means that you're going to be earning nothing on gold because gold's going to be going down. Now, that's that bit. Then you've got geopolitical tensions calming down, so I don't need to be hedging myself, don't need to worry. But the problem we've got now is, given that this big aggressive move to the upside in commodities has kind of shaken everybody out, everybody's like, you know what? If interest rates are going to be stay high for a longer time and Warsh is very hawkish, well, I'm going to be earning more interest on my dollar. I may as well start planting myself in my dollars, which is why the dollar itself is moving up aggressively. Okay? But what about Bitcoin? Well, of course, we're going to talk about Bitcoin. Let's have a look at what that's doing. What do we know about Bitcoin? Well, BlackRock's been at it again. It's been chucking these ETFs into Coinbase Prime. Let's have a look at the outflows. You can see 2 hours ago, we shifted quite a bit of Bitcoin. There's your problem, man. It's Wall Street's got your Bitcoin and they're going to do whatever they want with it. You allowed it. Now there's nearly 730,000 Bitcoin ETFs all just sat there getting ready to be offloaded. Everyone's all holding on to the idea of Bitcoin's going to do it. Bitcoin's going to do it. I hope Bitcoin does it. But Bitcoin is subject to event risk, man. Everyone is trying to sell themselves the idea. It's nothing to do with it. It's nothing to do with Israel. It's nothing to do with the interest rates. It's nothing to... What are you holding on to, man? What is it that you're actually holding on to? Play the game. Understand money rotation. If you're asking yourself, why isn't Bitcoin surpassing gold, given that all the money that has left gold should be going into Bitcoin? But if the dollar is going up against Bitcoin, what are investors doing? If they're not going into the stock market, where are they going? Well, let's just have a look at that. Let's just put it into perspective. Volatility index is trading negatively, which means that the stock market in principle should be trading up. Well, sort of is and it isn't. It's already gapped down and it is trading negative minus 0.52%. Okay, so sell the rallies is what they're saying on the street, ladies and gentlemen, because there's no real reason for the markets to go up. Let's work it out. Inflationary hype behind BlackRock. Interest rates are going to be higher for longer. Geopolitical risk is still present, given that you've got the Eurozone trying to piss off Donald Trump, and you've got the UK doing the same thing, and you've got this Cuba story, and then you've got this Venezuela with the oil. I think it's a commodities game where you're going to be seeing oil's price going up and down, which is why inflation is going to be a problem, because the more that Trump keeps on going on this hunt for oil, the more impact it's going to have on oil's price, which means that that's going to be increasing the cost of doing business and the cost of everything else, which is naturally going to have an impact on the PCE, which is already increasing. Am I going a bit too fast for you all? That's the question. I think I am. I think so. Let's slow it down. In front of you is Bitcoin's liquidations for the shorts, okay? And man, forget that. Listen, you're in the fastest markets in the world. You've got to get with the times. Going into it, Solana itself, I mean, you've got to be careful with Solana. It does move quite aggressively. But what you've got to be mindful of is Bitcoin, Solana, and Ethereum are currently stacked inside of the psychological ranges. Be very mindful with these two key areas, which is the first high and the first low that is formed at the start of a trading week. Monitor how price behaves around this range, okay, for your day traders. But for the big guys who are trying to play Bitcoin on spot, just be very careful, man, because we still haven't yet broken this key area down here at 74,500. And we do have a little bit of an interesting point down here. I mean, am I going to say it? Yeah, of course, man. 70K Bitcoin would be wonderful. And I think it's going to hit 70K. We are in event risk. Anything can happen. Anyone can say whatever they want. Whoever's going to piss Donald Trump off, let's try and put a tariff onto them. EU and the US, the Eurozone, have pretty much dismissed any discussion about trade talks with Trump. What do you think that's going to do? Geopolitical tensions usually leads to what? Safety in what? Dollars. Whether you like it or not. But what about gold? Why aren't they going over to gold? Well, is the idea of higher interest rates going to be wanting investors to go into gold because of geopolitical tensions? What's the other asset they can go into? What do you associate geopolitical tension with? War. Not that it will happen, but what is used for war? Oil. So I'll go over there and check out what's happening on that platform then. Let's go and have a look at oil. Where's oil's price at right now? Come on, oil. Where are you at? Here we go. So oil right now is trading at $62 a share. This is on the daily time frame, a barrel, sorry. And you can see that it has been trending upwards. We got a little bit of a gap over here, but I don't think oil is done just yet. I do expect oil to continue to move to the upside, and it is going to be fueled on the back of all this data that's going to be coming out regarding the US economy. If the ISM manufacturing prices do come in play at 59.3, which is what they're expecting, and the ISM manufacturing PMI comes in and shows expansion above 50, then ladies and gentlemen, oil is just going to keep on going up, in my opinion, because investors will be like, okay, we've got a problem with inflation. Investors are going to commodities for safety. They've already done their hedge with gold. Now gold is effectively being prepared for the next move. And with this aggressive move down, you see this here? You see that? They will be back to it. You heard it from me. It will go back to that spot. Shake everybody out. Do a reset. Kill the confidence. Load up, prepare for the next hedge. Go back and look at every single red vector candle. They do exactly the same thing. Why? Because we are technically in an easing cycle, but there's been a bit of a break. They've paused because inflation is still a problem. Once we get to terms with how inflation can be controlled, then gold will naturally go back up again, recover that red vector, and continue to make its narrative higher. Right now, there's a pause in the easing cycle, and that's all because of this dude right here. Not him, but Warsh. This guy right here with a nice clean, looks like Inspector Gadget, not expect anyway, Tino, shut up. But that is pretty much everything that you need to know about the marketplace today, guys. So just to summarize it, geopolitical tensions seem like they're calming down a little bit because Trump says that there could be a deal with Iran, okay? On top of that, gold traders are trying to get to terms with what's happened over the weekend, and of course, silver traders as well. But as we go into the CME Open, where the margins have been increased, there may be some more liquidation events that are coming into action. When it comes to cryptocurrency, you're all wondering if Bitcoin is now the time to start buying Bitcoin. MicroStrategy experienced a negative drawdown. Tom Lee's Ethereum position is the largest, if he closes it, the largest ever documented loss in history for a firm. So he's obviously itching because he did say that Bitcoin was going to hit 180K by January this year, or the end of January. We're in February now, bro. And you know what? You were good with equities, man. You smashed it with equities. Know your place, my bro. Stay with equities because you absolutely ripped it apart. I even used to watch you on that, and every time you spoke about equities, you absolutely ripped it apart. I don't think you're a crypto bro just yet. Never mind. I'm not a fully crypto bro because I came from the world of Forex futures and all the madness behind that. But it seems like we're using that information to help us understand about Bitcoin. Now, with that being said, we're going into the open the open is happening as we speak right now, and we have the ISM data coming out in 30 minutes time. All I suggest you guys do is just be very, very mindful when you are trading because you're trading event risk. Anyone can say anything in terms of news that can rock the marketplace, sell your rallies. Do not think that the market pumping up is the market's chance to keep on going up. I'll tell you why. Look, risk, hedging, okay? They're not fully there just yet. You've got the VIX going down, yet you've got the NASDAQ slowly trying to come back up, okay? But this week is a big earnings week, and it's all relying on Google, Eli Lilly, Amazon, the big boys, AMD. They're all declaring their earnings this week. If they do not come through with their earnings, your NASDAQ is just going to rip to the downside. If they do well, Get ready for an all-time high, ladies and gentlemen, a synthetic all-time high, because I'm not seeing the volume backing it at all. Down here, it's all negative. All right? So just be mindful of that. With that being said, guys, hope that makes sense. Mad love and respect. Hit the like button, subscribe and all that. And I mean well. Honestly, I do. And if I piss anybody off, please, I do mean well. But this is the tough truth of this game. You know? Welcome to the hardest, easiest way to make money. Yeah, I bet you heard that before. Peace.